Hi everyone, welcome back to Acorn FX, and today we'll be discussing technical indicators. And let's start off with our first one, moving averages. Using moving averages to assess trend direction is one of the oldest forms of technical analysis and remains one of the most commonly used indicators in the FX market. The prime benefit by moving averages is to reduce market noise, i.e. the rate fluctuations that we see minute in, minute out, makes it difficult to accurately interpret real-time exchange rate data. Essentially, what moving averages do is smooth out these fluctuations, making it easier for you to identify and authenticate potential market rate trends from the normal up and down rate fluctuations we see amongst all of the currency pairs. The aim of all traders is to seek a trend when studying this pricing data, and also attempt to identify a rate trend reversal from which we could potentially use this momentum to profitably trade. And moving averages can help in both regards, and the more frequent the rate updates, i.e. the more fluctuations, the more the price chart is updated, and the greater the potential for market noise. So moving averages really help us to essentially eliminate some of this noise and really see the trends. As we can see in the background of this picture, the very jagged lines are the usual price functions we see. The smoother line would be a moving average curve, which shows us in a more, not accurate, I'd say in a more simplistic way, showing the general trend level of the price movements. And the next pricing technical indicator we move on to is Bollinger Bands. They were developed by the analyst John Bollinger in the 1980s. And essentially these identify the degree of real-time volatility for each currency pair. As traders, we like to keep an eye on volatility because of a sudden increase in volatility often precludes a market trend reversal, and Bollinger Bands are placed over a price chart, consist of a moving average together with an upper band and a lower band, and these essentially define pricing channels. Standard deviation, for going back to college maths, the first standard deviation is about 68% of the data points, and two standard deviations include about 95% of all data points. However, with the FX market and the advances in technology, we don't have to calculate these ourselves. They're done automatically through the software, and you only really need to understand the theory behind how it sets the average ranges, for which we can use the buy and sell channels. Now, the buy and sell channels between the upper band and the average line is what we call a buy trend, where we see the price is going higher than the average price. So it would be potentially looking at buying that currency pair, and conversely, if the price is between the middle average and the lower band, we call a selling channel because we see the price is likely to go down. So this is a very clear indication that helps us visualize the data in a bit more detail and see how these trends are moving, and are they moving in tandem with our expectations or outside. So as you can see in this example above, when the price is reaching the top of the band, i.e. in the right hand side of the picture, you can see this is called breaking the bands, where it's going to break this trend. And our final financial indicator that we're going to look at is Fibonacci retracements. The first thing you should know about a Fibonacci tool is that it works best when the Forex market is trending. The idea is to buy on a retracement at a Fibonacci support level when the market is trending up, and conversely to sell on retracement when the market is trending down. Fibonacci retracement lines are based on the Fibonacci sequences, and they provide a predictive technical indicator providing some sort of feedback on possible future exchange rate levels. Now, there are some traders who swear by the accuracy of the Fibonacci retracements, while others argue that it's more of an art rather than an exact science. I recommend you proceed with caution and use your own judgment and your own experiences on how you should envisage using the Fibonacci going forward. Fibonacci sequence is essentially a series of numbers that seem to consistently occur in nature. Discovered by Leonardo Fibonacci in the 13th century. He's a famous mathematician. I'd recommend you all read up on his stuff. Excellent work that he's done. And the method is essentially to calculate a sequence to add any Fibonacci numbers together and next to each other would lead to the next Fibonacci sequence number. So 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 5 plus 3 is 8, 8 plus 5 is 13, and so on and so forth. So what is my favourite technical indicator? Now I'm going to have to sit on the fence here and say all of them. The reason behind why is because I don't feel personally that there's one particular type that is significantly more accurate than the other. I feel it's more of a subjective decision and depends entirely on your skill set and the type of trading that you like to do to see which would best fit in with your trading strategy. Thank you very much. Please subscribe below and leave any comments. Thank you.